Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. Thank you for joining me today. As SBA lenders, you play a crucial role in fueling small business growth. And today, I want to talk about something that can make or break your underwriting decisions: valuation multiples. Today's topic, when bigger multiples mislead, is tailored specifically for you. Because in the world of SBA 7A loans, getting valuations right isn't just smart. It's essential for managing risk and supporting sustainable deals. Let's start with a familiar scenario. You open the news or sit through a pitch and there they are. Flashy multiples from public companies, private equity giants, or hot sectors like software as a service. You've probably heard about enterprise value to revenue multiples of 5 to 8 times. Enterprise value to earnings before interest, taxes, depreciation, and amortization? That can range from 8 to 15 times or even higher. The S&P 500 average? Often around 10 to 12 times, thanks to low risk, massive scale, easy liquidity, and transparent financials. But here's the catch, and I know many of you have seen this firsthand. Those numbers don't match the reality of the small, privately held businesses you're financing. Owner-operated firms with revenues under $5 million. Their real-world deals tell a very different story. And misunderstanding that gap can lead to overvalued collateral, inflated expectations, and loans that go south. So why are private business multiples so much lower? Let me break it down for you. First, illiquidity and marketability. Public shares trade instantly, private shares don't. There's friction, legal hurdles, limited buyers, and uncertainty. That usually means a discount of 20 to 40% compared to public companies. Second, size and risk premiums. Small businesses carry more risk: customer concentration, owner reliance, limited diversification. Buyers demand higher returns, and that pushes multiples down. Third, limited transparency. Public companies have audited financials available to all. Private firms, not so much. Valuations hinge on adjustments, owner perks, normalized cash flow, discretionary spending, and those adjustments introduce uncertainty and lower valuations. Fourth, outdated or lagging valuations. In the private market, especially in M&A, sellers may use outdated comps or legacy pricing. That keeps multiples anchored in the past rather than current market conditions. Fifth, scale in the buyer pool. Public multiples come from big deals backed by institutional capital. Your SBA deals involve local buyers, individuals. They don't have that scale or leverage, and the valuations reflect that. Let's bring this down to real numbers. Public S&P 500 companies. Enterprise value to revenue is generally 1 to 3 times. Enterprise value to earnings before interest, taxes, depreciation, and amortization is 8 to 12 times. Small private business transactions. Enterprise value to revenue is 0.3 to 1.0 times. Enterprise value to earnings before interest, taxes, depreciation, and amortization is 2 to 4 times. Why does this discrepancy matter to you as lenders? Because when a broker says, "This business is worth 8 times cash flow," it often sets false hopes for the seller, the buyer, and even the banker. Most small, owner-run businesses don't have the margins, scalability, or risk profile to support those multiples. And when we overvalue them, we risk under-collateralized loans and weakened portfolios. Here's 4 practical takeaways for you. First, benchmark to private comps. Public multiples are almost always too high for SBA-sized deals. Stick with what the market is actually paying for small businesses. Second, adjust for business characteristics. Is the revenue recurring? Are margins strong? Is the owner replaceable? Are customers diversified? Every factor influences value. Third, flag outliers. If a deal's multiple exceeds the expected range, dig deeper. Maybe it's justified by growth, a strong brand, or a strategic buyer, but maybe it's a red flag. Fourth, document and support. Use heuristics, but back them up. Track your assumptions. Reference databases like BizComps or ValueSource when appropriate, and always cross-check with what you're seeing in your own deals. Before I close, let me give one very important caveat. Multiples can be useful tools, but they are not a substitute for a proper valuation. Every formal business valuation should start with one core question: what is the net free cash flow to the buyer, and what return should they require given the risk? That's the foundation of the income approach, and that's what most qualified appraisals rely on. The multiples you see in the market? They're just shorthand for what buyers have historically paid relative to revenues or earnings. But those numbers are often inconsistent, backward-looking, and don't adjust for the unique risks, cash flow volatility, or capital needs of the business in front of you. In fact, the valuation multiples we've shared today are helpful as a sanity check, not a valuation conclusion. If you're underwriting a deal and the implied multiple is far outside that range, it's time to slow down and ask, is this justified by sustainable cash flow, or is this just wishful thinking? At the end of the day, valuation is about risk versus return, not rule of thumb. Multiples give us clues, but cash flow gives us answers. While public multiples might dazzle in headlines, they can seriously mislead when it comes to valuing the small businesses you serve. Privately held companies don't enjoy the luxury of liquidity, scale, or transparency, and that's why they trade at materially lower multiples. By bridging that gap and aligning expectations, you can support better loan decisions and empower entrepreneurs to succeed. Thanks for joining us for this episode of the Valuation Desk. When you need clarity, confidence, and credibility, experience makes all the difference. At Highland Global, every appraisal is backed by decades of expertise and thousands of completed reports. We don't just crunch numbers. We provide insight, context, and defensible conclusions that lenders can count on. Whether it's a business acquisition or equipment appraisal, our seasoned approach helps ensure your deal moves forward with precision and trust. For more information on valuation-related topics, be sure to visit our website highlandglobal.com. Lenders know experience matters most.